I'm going to guess that you have a large individual holding within your portfolio. You think you're in a good spot to retire, but you just don't know. And should you hold on to the stock? When should you diversify? How do you think through all the tax consequences if you are going to diversify? That's exactly what this case study is going to be about. So a large reason people reach out to us is they're going, hey, I know I'm in a good spot, but I don't know how to optimize when I should sell. I don't know what the implications are of when I can retire, how much can I spend? So the majority of people are going, I just want to make sure I do it right and I do it once. A lot of our clients work at Microsoft, Apple, Google, and they've got a significant concentration in one position and they want to make sure they're doing the right thing. So in today's case study, I'm going to show you both the risks and, by the way, a lot of our clients go, I really love this position. I want to keep it. We say, great, here's the trade-offs of doing so. And they go, wow, that's helpful. I'm going to hold on to it, but only to this degree. Or you know what? Nope, I see why you're recommending this diversification, but right now isn't the right time, so let's do it in 2 years because we're going to be doing other tax strategies. So it's just having that cohesive strategy. If you don't already know, I am Ari Taublieb. I am the Vice President here at Root Financial. I am the host of the Early Retirement Podcast. And finally, I'm a certified financial planner. So we're going to hop right in. I'm going to show you a real case study so you can see exactly where I'm coming from and see if it relates to your situation. So the client that came to me, I changed their name for security purposes, but let's call them Jeremy today. And Jeremy's 59 and he says, I want to know when can I retire? I've got a significant concentration in one individual position. That position is Microsoft. So this is a specific employee that works at Microsoft and is going, I want to make sure I'm thinking about all the right things in terms of when I retire. This particular client was like, I just want to know yesterday, can I stop working? And they don't have a spouse, they don't have children. So that changes the plan because if you want to leave $2 million to a child, that's very different than if you say, I don't want to leave any assets and I want to travel and do some of these other things. So before I even showed him the potential Microsoft changes, I'd say, hey, let's assume you stop working next year. Most people want to know when they can retire. It doesn't mean they actually do. More often than not, they find something that's a whole lot less stressful and that they actually enjoy. Jeremy wanted to spend $5,200 a month. We planned on some annual retirement healthcare costs, long-term care, and then he had some very specific travel goals where from now, call it 60 till 72, he wanted to spend $40,000 every single year and then $20,000 a year for 8 years beyond that. So these were Jeremy's specific planning goals that we discussed. He has his income today, which is $245,000. That's salary and bonus, but that does not include RSUs, other options, ESPP, and things like that. This is the financial situation of this individual where they have $35,000 just sitting in cash, savings, and checkings. Then within their investment portfolio, Jeremy has a 401k with $820,000. That's a current 401k at Microsoft. And then he has a rollover IRA. So that's from a previous company with $153,000, a Roth with $77,000. And then he's got Microsoft stock worth just about $4 million. So he's wondering, hey, am I in a good spot to make this happen? I imagine that's a lot of the thoughts of those that are watching this video right now. And right off the bat, you're going to see that he's in a good spot. Now, my concern with this, and even if this says you have a 100% chance of success, that's not good to us, by the way. That's you're dying with way too much money and you're going to wish you would have spent more along the way. And we don't want you mad at us when you're in your 80s, having tons of money going, hey, why didn't you give me the confidence to retire 6 months earlier so I could have spent more time traveling or doing what I wanted to do or take a job that is way less stressful that I would actually enjoy more. So this client wanted to know, number one, am I on track? And so here we are with assets of $5 million, a little north of that. And it looks like they're on track for $19 million at age 95. So generally, Jeremy would look at this and go, yeah, I'm on track. Now, 19 million is not going to be worth 19 million in the future. So we have to go, okay, what's that actually going to represent? 19 million will be the equivalent of about 6.8 million. Now, there's a lot of assumptions that go in here. It assumes Jeremy passes away at 95 and he wants to spend $5,200 a month every single month, but those additional years for travel. So what if he said, you know what, that's not cutting it. I'd rather spend 8,000 instead of 5,200 and still do all that travel. Well, he's still in a good spot. Yes, there's 1.8 million fewer dollars, but he's still in a great spot. And so what we don't want you to do is go, yeah, I'm not going to take the trip, or I'm not going to even think through health insurance, what that might cost me. I'm just going to keep working. I don't want you to do that. I want you to plan for it well, and that's why we exist. So This all assumes moderate growth. This is my biggest concern. When people are running planning projections, they just assume markets are going to keep doing what they're doing. Now, I released an episode where I said, hey, how to protect against the risk of just getting unlucky, meaning markets go down, you retire early, where's income going to come from? So you can see I have a podcast episode right here where I talk about that. But the issue here is it assumes you're going to get moderate growth forever. We know Microsoft stock isn't just your average stock. It's done really, really well. At the same time, we don't know what it's going to do in the future. So just basing Microsoft stock getting 6% per year is unrealistic. So some people go, hey, show me this. What if it just got really minimal growth? We're talking 2-3% per year. Jeremy would still be okay, but there'd be 1.2 million instead of 6.8 million. Now, on the other hand, if it was in a really aggressive portfolio, Jeremy could legitimately have $10 million plus. And so a lot of what he's relying on is based on Microsoft stock. So level 1 of planning is, are you in a good spot to retire? Yes, Jeremy's in a good spot to retire. I think he knows that. I think you know that if you're in a similar position, but you're wondering, okay, what else can I optimize? And that's what we're going to talk about now, which is level 2. I like to try to keep things fun as much as I can. And so I'll compare Microsoft versus the S&P 500. And this might not seem fun to you, but it's really fun to me because I get to show my clients and I'll ask them fun questions and I'll say, hey, let's assume that you kept Microsoft forever. What's the worst case scenario? They go, well, technically it could go under. I go, yeah, but that's unlikely. They go, yeah, but technically it could happen. I go, yeah, and you're asking the right questions. Technically that could happen. If every single company in the S&P 500 went away, there'd be bigger problems in the world. So it's not me saying I hate Microsoft and I love the S&P 500. Microsoft is in the S&P 500. What I'm saying is I don't want your retirement to be dictated by whether Microsoft does good or does bad. I want to make sure no matter what happens, you have your income in retirement. Now, Microsoft stock's done really, really well, and a lot of my clients know that and they want to keep a portion of it. Some of my clients want to keep all of it. It's not my job to say do this or do that. It's my job to quantify the trade-offs so you can understand the magnitude of each decision. Worst case scenario, Microsoft goes to 0 and Jeremy can't take the travel he wants to take. Now, yeah, he could be potentially missing out on Microsoft gaining another 10, 15, 20% per year, but he doesn't need that in order to be okay. So he might want to keep a portion because he feels it's going to continue to rise, but you don't have so much that you're actually shooting yourself in the foot and now all of a sudden you can't actually do what you want to do. I've seen that before. I've also seen people get rid of Microsoft stock or whatever their position is that they have a significant concentration in. And all of a sudden they're kicking themselves because it goes up 50% and they go, oh, yeah, I wish I would have kept it. Why didn't I think about this more? And they're in a good spot, but it's still beating them up inside knowing that they've maybe left hundreds of thousands of dollars on the table. So once again, no one has a crystal ball, but here's how I would think through it. Number 1, what's the worst case scenario? Well, worst case scenario, it could go to 0. I go, what's the worst case tax-wise? Worst case is long-term capital gains at 20% plus net investment income of 3.8, so call it 23.8%. That's the worst case scenario that you're going to go pay taxes on. I'm not saying that you should go do that. Now, technically, you could pay short-term capital gains, but assuming you hold it for over a year, like most of my clients, you're looking at about 23.8% of an actual tax bill if you were to just go sell everything. So the first thing for my clients that are coming to me with a significant concentration risk is I like to show them a comparison. Yes, to validate that what they're thinking is correct, but also to make sure they understand the trade-offs here. So this graph looks really good. This is showing that over 3 years, the S&P 500's done really well. It's up 42%, but Microsoft's up 87%. Now, this is not the only graph I'll show, but this is an important one. We then want to take it to the next level and go, okay, let's look over the next 1, 3, 5, 10 years. What's outperformed? What's underperformed? How do we think through this? Microsoft in the last year, up 64%, 3 years, 23%, 5 years, 31%, 10 years, 29%. That is blowing out the S&P 500, and so it almost looks like a no-brainer. But what we don't want to do is have recency bias, where we simply hold on to what's done well because it's done well recently. Now, this risk metrics graph, this is more in alignment with what I would be going over in the very serious part of my meeting with my clients, where it's let's understand the risk and understand, are we really getting value for the potential return that we could get? So we can look at the risk or the standard deviation of the S&P 500 versus Microsoft, which is another fancy way of saying how much risk are we taking for the potential return that we could get. And so the S&P 500, the risk, when it's bolded here, this means that it's got less risk in relation to the return it could receive. And so the really important line here is this one right here, maximum drawdown, which means what was the worst case scenario over any of these time periods? What would have happened? And so over the last year, the S&P 500, it was down 10%. That was the worst case scenario. Then Microsoft was down 13%. So you go, okay, Microsoft was up a whole lot more and it would have only been down a little bit more. Now, if we look over 3 years, Microsoft was once down 37% versus the S&P 500 down about 25%. So you might go, Ari, I'm riding out these waves. This is no problem. I'm working today. Yep, stock goes down. I go get more. Great, that might be you. But when you retire, that won't be you because you're not still going to be working. So it's where on earth is income going to come from? And if Microsoft stock's down, you don't want to have to go sell at a loss. So being really strategic here is crucial. Now, if we look at 5 years or 10 years, you can see that the S&P 500 was down 33% at one point and Microsoft was down 37%. That was the worst case. Now, we always want to look at this and go, okay, that's really interesting. But once again, this is only 1, 3, 5, 10 years. What if we go out further? And this is the next graph that I'll show. I don't show a lot of graphs. I don't want to make my clients fall asleep, but I do want to make sure they understand why we're doing what we're doing. And so the green is during these really big downturns, what would have happened to your portfolio. So during the tech bubble, the S&P 500 was down 20% versus Microsoft down nearly 49%. World Trade Center attack, 11% S&P 500, 13% Microsoft. Subprime crisis, Microsoft down 42%, S&P 500 down 40%. Now, anyone could go, Ari, you're picking different ones to illustrate why this is better. I don't care. I care that my clients retire and have income for the rest of their life. I don't care if Microsoft helps them do it, Apple, S&P 500, Tesla, whatever it is. The point here is I want to really stress test what's the most optimal way to do this. And by showing them, hey, here's the potential downturns. Is this a risk you'd be comfortable with? If your 4 million went down to 2 million in a year, would you go, oh my gosh, I'm going to write it out. I love Microsoft. Or would you go, no, maybe that's a time to get out because I don't want you to have to sell at a loss. So these conversations are a whole lot different when you are accumulating versus when you're actually nearing retirement. So level 1 is, can you retire? Yeah, Jeremy can retire. Level 2 is he can retire, but if markets go like this, especially Microsoft goes like this, it's going to be very difficult. So what he needs to do is have a conversation with the planner to go, how much do you want to spend? How does that change over time? If Microsoft stock went down 50%, would he still be okay? In this case, Jeremy would be okay. He could still do everything he wanted to do. So when I spoke with Jeremy, he didn't want to keep everything in Microsoft, and he was more than open to going and selling what are called specific lots based on when it was purchased or when the stock was granted to him. And he went and sold those specific lots. And so he was paying gladly $50,000, $70,000 in taxes to diversify a lot of stock that he said, I'm willing to make sure that I still have my skin in the game, but I want the majority diversified because I know what's most important, which is I want to travel. And I don't want to be traveling going, hey, if Microsoft goes down, checking my phone every day, does that mean I'm not able to retire? He just didn't want the stress, and he knew he was leaving money on the table, but we're all leaving money on the table. We could, and my dumb joke I tell all my clients, if you wanted to just have the best withdrawal rate, meaning the lowest, and never run the risk of running out of money, keep working 30 more years. Your plan will look amazing, but that's not the point. The point is actually to have the highest withdrawal rate. Take the most out of your portfolio without even running the risk of running out of money. The way you do that is you say, great, here's how much stock I can afford to lose. Here's the tax implications from us doing that. And then once your income is really low and you are retired, dependent on if you have a pension or not, or rental income or Social Security, you start implementing really effective tax strategies. So that's the last thing I'm going to show you briefly here. So what on earth are we looking at? This is Jeremy's future tax situation. So here we are today. His income is relatively high. Then it's going to drop. Now, yes, he's going to be selling some Microsoft stock. There are tax implications. But for the future years, from really 61 until Social Security begins, which for Jeremy's at age 70, he's got some planning opportunities where his income is low and he can implement strategic Roth conversions that can yield $1.2 million more over the course of his lifetime. For some people, this will yield $4 million plus dollars. For others, it'll be $200,000. It depends on your RMDs, which are required minimum distributions, the amount you'll have to take out starting at age 75 for most of you. And then really it comes down to how much do you want to spend? What about health? How much do you want to give to children? So your Roth conversion should be a dynamic figure. It shouldn't just simply be, yep, we're going to convert X amount every year. This is what Jeremy would move from his 401k into his Roth IRA, or his IRA that was a rollover into his Roth IRA. So what we're doing is we're going and looking at every single tax bracket and saying, great, we filled up the 10%. Awesome. What about the 22%? What about the 24%? What about the 28%? So really saying, what can we do in these years to minimize the future tax bill? Because if we don't do this, which is the risk that Jeremy runs here, is that he's going to be forced to take out more than he needs. His RMDs could be in excess of $200,000. And as a reminder, he doesn't want to spend as much on travel in his late 70s and early 80s. For the rest of his life, he'll have significant RMDs that are all taxed at his highest marginal bracket. So whether it's implementing Roth conversions like this or other tax planning strategies, that's the real opportunity. If you are considering early retirement and you have significant concentration in a stock, you want to be really strategic so you retire with total confidence without worrying about any of the financial stuff while you're doing what you want to do. If this case study was helpful, please do drop a comment and let me know. If you currently work at another company and want to see another analysis, always happy to do it. And as always, this is what we love to do. So if you're looking for a custom strategy, make sure to apply to work with us. And you can head to our website, rootfinancialpartners.com, to do just that, or see in the description of this video a link where you can apply to work with us. Love you guys.